The US dollar has fallen. One US dollar is now worth around 9% less than at the start of the year. Investment bank Morgan Stanley thinks that the greenback can fall further by another 9% by the middle of 2026, and that's one of the more conservative forecasts. Currencies do rise and fall, but what's different about the dollar's decline this time around? And where should you put your money instead?
Moody's downgraded US credit worthiness, so we're starting to see a capital flight out of the US. What we're seeing now, it could be a hint, a glimpse into a future where investors across the globe lose their confidence in the US, and therefore the US dollar reserve currency status and a safe haven currency status is therefore being threatened.
Despite that, strategists say you shouldn't ignore US stocks. Since April's tariff-induced market meltdown, US stocks have largely recovered their losses, and trillions of dollars are flowing through the US market. So look for pockets of opportunity, like defensive stocks. You may also want to consider multinationals that derive a large chunk of their revenue outside the US.
Some US multinational companies actually do better with a weaker dollar. Companies like Apple, Microsoft, and other tech giants, they generate more than 50% of their revenue internationally. So you see a positive earnings per share impact when the US dollar actually weakens. So in a sense, for Singapore investors, there's a partial natural hedge built into holding US multinationals with high proportion of international revenue.
And you may want to stay away from US government debt, especially after Moody's Ratings became the third and final credit rating agency to downgrade US government debt.
US government debt may be less appealing unless the yield stays attractive. Currency risk as the US dollar weakens, plus potential Fed rate cuts which could pressure the bond prices. When you combine these falling yields with the weakening currencies, total return picture for Singapore investors becomes very unattractive. Investors can consider Singapore dollar denominated bonds or Asian bond funds.
In times of uncertainty, it's crucial to diversify your portfolio. Away from the US markets, consider European or Chinese markets.
The German DAX has been performing well. The French CAC 40 index has also been performing well. In terms of interest rates, if you want to generate higher interest returns on the currency that you're holding, then the UK actually comes close to the US.
If you look at it not so much as a dollar weakness story, but as a sign of US walking away from their commitment to international trade and their commitment to global geopolitics, Europe cannot rely on US to come to their defense if there's a war. So which means the defense spending in Europe is going to go up, and in Germany particularly is going to go up. And same is the case with China, right? But now, the fact that US has become a bit unreliable and will make some countries rethink their affiliation to the US, and perhaps they could open up a lot more on trade and other collaboration with China. And that could open up side in Chinese markets.
Analysts say Chinese equities remain undervalued and underowned.
And the other advantage for Chinese markets is that purely from a valuation perspective, they're definitely undervalued. So this could create momentum and diversification into Chinese assets, and particularly Chinese tech at large. And EV is a great story. But even in AI, they're making rapid strides.
Emerging markets through ETFs are also something our investors can look at, like iShares, MSCI emerging markets. These provide exposures to regions that typically perform well during instances where the US dollar weakens.
Keep in mind the strength of the Singapore dollar. When the Singapore dollar strengthens against the US dollar, US-denominated investments will convert into fewer Singapore dollars, reducing your overall return.
When the US dollar weakens, your profits in US dollars are actually worth less when you convert them back to Sing dollars. For example, if there's a 5% decline in dollar Sing, effectively this reduces your US stock returns by the same magnitude when you convert them back to Singapore dollars.
For us as investors who have invested in the US market, there will be taxes that have to be paid, right, on the gains made in the US. And then after that, when we convert this US dollar back to the Sing dollar, right? We are going to lose again, and then by the time we fully convert it to Sing dollar, right, our dividend returns in the US would already have been eroded twice per se.
So, for income investors grappling with less attractive returns stateside, consider Singapore-listed stocks.
Our regional banks, UOB, DBS, these companies are positioned to capture such capital flows. For yield-focused investors, Singapore REITs like Fraser, Centrepoint Trust, Keppel DC REITs, these both offer yields and currency stability characteristics. Infrastructure companies like Keppel and Sembcorp are also interesting for their infrastructure and renewable energy exposure. So these represent long-term structural themes that could benefit from both Sing dollar strengthen and the regional growth trends.
The strengthening Singapore dollar will also benefit local importers.
So for ComfortDelGro, the benefits directly from lower fuel costs, since fuel is US dollar denominated. Another Singapore stock to look at, Sheng Siong. Sheng Siong sees improved import margins from stronger Sing dollars. So when you're importing goods for retail, currency strength goes straight into your bottom line revenue. Sembcorp Industries, with lower costs for US denominated inputs in their utilities business.
Putting some of your money into safe haven assets like gold could act as a portfolio hedge if there's a breakdown of trust and confidence in the US economy.